What I love to do is introduce the right people to the right people.
I assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome.
Okay, guys, Jay Martin here, CEO of Cambridge House, and I'm joined once again by Tavi Costa, Portfolio Manager at Crescat Capital. Tavi, how are you?
I'm great, Jay. Thanks for having me again.
No, I'm excited to have you back and pick your brain on a bucket full of topics. Last we spoke was January. So yeah, right at the beginning of 2021. And lots has changed. The year kind of started, well, it started pretty sleepy in the commodity space. And that's now looking like it's changing. I shouldn't say sleepy in the commodity space, but a bit sleepy in the gold sector. So anyways, where I want to start with you is you and your partner, Crescat, have been talking about the change in sentiment and I guess the change from growth stocks to value stocks, right? The change from financial assets to hard assets. And I've heard you refer to this as the great rotation. So if we could start there, Tavi, at a high level, what is the great rotation? What's occurring right now in the market?
Well, it involves our views about inflation as well. And I think when cost of capital begins to rise for whatever reason, labor cost or inflationary pressure, you begin to move away from high-flying multiple names such as tech companies and capital starts to flow into especially tangible assets in general. And so when you have a situation where it's very difficult to find anything that has yield, S&P 500 earnings yield is actually below inflation today. Corporate bond yields do the same. You look at the treasury market, it's difficult to justify buying that as well, given where we are, again, with relative to even bogus CPI or any other inflationary gauge. And so the difficulty of finding yield and the scarcity of assets that can offer anything either above inflation or above zero is forcing folks to look for tangible assets. And that begins to drive natural resource stocks. And that's why I think most of those are part of the value names. And that rotation that we're seeing has a lot to do with that. And it has a lot to do with the commodities to equity ratio, which is at a fresh 50-year low, or it was before this run up in commodities. But when you looked at commodities relative to equities, it's still incredibly cheap. And so this is just the beginning of a bigger move in my view. And at a time when, I think investors are beginning to realize that there's not a real case, a bullish case for equities, especially the tech names and the ones that have very strong or very high valuations. And so, what is the bullish narrative here? We're talking about, we went from yield curve control to now talk about tapering in a matter of a few weeks. That's not bullish. And so, or if we go back to the talks of doing more money printing, then we're going to just reinforce the inflationary issues that we're seeing. And so that's also not very bullish. We've had 2 decades in the past century or so of inflationary forces going above 6% on a median basis year over year. And that was the 1910s and the 1970s, not the 1940s. That was not at all, actually. That had some sporadic increases in inflation, but it was well below the entire decade of median CPI. And so it's not a good decade to look at in terms of how assets really behave. In the 1910s and 1970s, you saw, first of all, commodities doing very well. In the equity market in general, if you look at just the S&P or the Dow Jones, which was the data available since the 1910s, what you find is that the equity market was barely up, was up about 1% in annualized terms. And when you consider inflationary forces, you got real negative returns in those decades. So I think there's a lot of misunderstanding of how equities may react. And then again, we're seeing an improvement in the economy. Remember the disconnect that we saw in 2020 of financial markets doing incredibly well, but the economy doing very poorly. And now we're seeing the opposite, where the economy is doing better and the markets are not doing so well. I think that's probably going to continue again. And that's a product of stagflationary environment. So I think that's where we are in right now.
And do you see, so thank you for that. And do you see investors' sentiment shifting as in becoming more risk averse? And those names that you mentioned, a lot of the tech names, the historic growth stocks over the last decade, I mean, not only are they hitting all-time highs, valuations are crazy, but also are you seeing a trend of investors looking for companies that are actually generating profits today more so than they were a couple of years ago?
That's, I think the sentiment is starting to change. I think folks are beginning to realize the value proposition in value stocks. And starting to find that a lot of natural resource companies have not only the value proposition, but also a lot of embedded growth in terms of the factors of free cash flow and revenues and margins. Everything is improving significantly relative to the tech names. I've shown the chart before, free cash flow yield, for instance, between gold stocks and tech companies. And for the first time in 30 years, gold stocks look more attractive on a free cash flow yield basis than tech companies. And so the party hasn't even started yet. Gold is, in my view, very undervalued relative to a lot of things such as the monetary base and money supply, equity markets, and what we're seeing in terms of policies. And so certainly things are changing. And when you have this environment where cost of capital begins to rise, and you start to see things like profitability becoming a priority. And so quantitative or fundamental factors are also cyclical, and they change over time how investors tend to rely on different things. The last decade or so, growth was certainly, especially the top line growth, and not making money was certainly the priority for investors, and how a lot of companies have done so well. You name it, from Netflix would be a great example to Uber and other names that have done so well, especially in the tech space. And then some of them became profitable. That's fine. Amazon is a great example of that. But the majority of them actually are not extremely profitable relative, especially with the valuations don't justify the investment in those places. Unless you have a deflationary environment, then certainly makes sense. Now, what we're seeing here is a change where cost of capital is beginning to rise. Regardless, we can talk about why. I think there's three pillars into that are very important that are going on right now. And as we see that changing, I think folks are going to start looking at bottom line improvements a lot more and giving that as a relevance, especially for quant models and just fundamental analysis in general. So the in-depth analysis of looking at annual and quarterly reports is back. And I think that's going to be a big change. And some investors are not, you asked about sentiment. Yes, that has started to change. Some folks are beginning to realize at least the opportunity on commodities. But most of them are focused on the supply bottlenecks, which I think, was certainly something we were talking about in our last interview regarding the similarities with the 1919, the Spanish flu environment that we saw back then, and using that as a roadmap for what's happening today. But there are a few other things that may come out from this that happened back then that I think will also change and kind of shape this investing landscape, and may cause some changes on how we look, especially and give more relevance to profitability.
I want to jump into those three pillars, if we can. And in a couple of comments you made about investors moving towards companies generating free cash flow. And I think you tweeted relatively recently something like 73% of miners right now are generating positive free cash flow. The significance of that number is that that's higher than it's ever been in my career in this business, right? Significant.
Yes, and I just want to point out that that's for the top 50 miners. As we all know, there's a very large universe of companies that still don't make any money, and a lot of small market cap companies that are trying to find discoveries all over the world that don't have free cash flow. But when you look at the top miners, then most of them are actually now profitable on a free cash flow basis. If I could answer the question about the three pillars of inflation, which I think it's so relevant for what's going on right now, it starts with the demand side. What we're seeing in terms of savings that shot up to $6 trillion or so back in March and April of 2020, unleashed somewhere close to $3.6 trillion of consumer spending, which when you look at that in a historical average basis, about 7.5 times higher than any other time on an annual basis in history since the 1960s, inflation adjusted. Okay, so right now, why is this relevant? Is because we just shot up again to $6 trillion with the recent fiscal spending that we saw in helicopter money policies of giving money to the population. This is going to unleash a massive amount of consumer spending again. And so it's difficult for me to see a deflationary environment with such a strong pillar of inflation moving towards that direction. And I don't think the supply chains are actually ready for that again. Why? Let's talk about the second pillar. That's the cost push one, which is divided in two parts. One of them is the supply issue, which we discussed very in depth in our last interview, which again goes back to the 1919 Spanish flu environment, when we had not only, it wasn't really aggregate demand that was driving consumer prices higher, it was constraints in the supply side of things. And so, again, we're seeing this one more time in another pandemic situation. And what comes out after that, which I think is what matters, right? If we call it, well, what happened in the last few months, let's now talk about the following months. I think we're at the early stages of an upsurge in labor management conflict, which will cause, in my view, labor costs to rise. We're starting to see that some of those companies, more popular companies such as the McDonald's of the world or Chipotle and some other restaurants, are beginning to be forced to raise labor costs in order to bring people back to work. And one thing we didn't see in 1919 was the fiscal policies were not really discouraging folks to go back to the labor markets. This time around, we're certainly seeing that. And funny enough, the policies that are trying to answer and trying to improve the recovery process are actually the policies that are also making things a lot worse. And so the third pillar of inflation that is also becoming an important part is the monetary debasement issue. This framework that we've solved so far, especially from investors to try to justify what the Federal Reserve is doing. In other words, the dual mandate of maximum employment with also stable inflation. Look, that's over. I mean, that's not what the Federal Reserve is doing. That's very clear. And if you look at if you do any macro data analysis, you know that there's no way they're justifying, unemployment or labor market issues and inflationary forces being low in order to justify the quantitative easing and the near zero, interest rate policy that we're seeing right now. It all comes back to suppressing interest rates and allowing the government to do the fiscal spending that we saw so far, and having to have the interest rates low in order to allow the government to have debt to GDP at 140+%, as we saw largest level in history, and also valuations. The Federal Reserve knows that a 10-year yield at 4% or so would never be a good factor for the equity markets at record valuations. And so those are the issues right now. And the way they deliver the message right now is with this dual mandate, which has been the case, and it's becoming more and more of a broken record when you listen to them, not concerned about inflation just yet, is looking at their CPI bogus number, which I don't like to say that usually, but I don't think CPI is really representing at all what's going on in the system, especially their own CPI. When you look at median CPI from the Federal Reserve, it's at a 7-year low. So when you combine all those factors and the three pillars of inflation, I think it's very difficult to see that turning around. And I think there is a big chance that we may be triggering a long-term inflationary problem. And if we're entering that environment, I think you have to invest accordingly. And in this case, commodities look very interesting still. Some of them had a big run, and I prefer looking for others that still look incredibly attractive relative to others. But look, I think that the whole space is going higher, and that great rotation situation I was referring to will continue to occur, in my opinion. And it's going to change how money managers do following, especially different approaches, such as a value approach, maybe is starting to get in favor rather than out of favor, as we've seen so far. And so those are the big changes right now.
Okay. Now we got to talk about the renewable energy trend a little bit. And, a statement that's come up on my channel a handful of times, and I've seen it make it headlines otherwise, is that copper is the new oil. And I think it's an imperfect statement. I like the way Warren Irwin responds to that, saying copper isn't the new oil, copper is the new pipeline, which makes a bit more sense to me. But Tavi, the macro trends driving copper demand are reflected in the copper price surging to all-time highs. But the copper miners are where there's some awesome opportunity, and the explorers. Are you guys at Crescat deploying capital? Have you been deploying capital into the copper space?
It's always been more complementary because of our views about looking for more monetary metals, and especially the ones that can really benefit from a monetary debasement environment, such as gold and silver. However, I'd rather be long copper than be long NASDAQ. And so the cyclicality of copper is something that concerns me a bit, given where we are in the business cycle and this still euphoric environment in general that we're seeing in terms of investment sentiment out there. But I was discussing a lot of this with some of the large gold and silver miners. This is maybe a year ago or so, and asking questions about copper. I remember that so well. None of them wanted to really increase their, was really attracted to the idea of increasing exposure to copper. I thought that was interesting that now they're changing their opinion, and it seems like prices change people's opinions. It should be all the way around. You should be looking at the factors to see if prices will be impacted by that. The relative, I guess, analysis between copper and oil is interesting. I think copper has more long-standing, especially demand factors for going forward. However, oil does have a high probability, in my opinion, of going well above $100 a barrel in the following months, given not only the supply issues, but this consumer demand that we're seeing in places, especially like New York, with traffic coming back, not because people are going back to the office as much, but really because no one wants to take public transportation right now, and so a lot of people are driving instead. And so those will have an impact on oil in a kind of a shorter period of time. We're certainly trying to move away from oil, which creates an incredible opportunity for oil in the short term and medium term. The long term, and I think copper looks much more attractive. We've had a very big run recently, and some other base metals I think may look a little bit more attractive than copper, just because of the run up recently. And when I keep thinking about this cyclical, the green agenda, something that fits that environment with the supply constraints, that also serves as a monetary metal, I go back to silver immediately. I think that's the cheapest metal on earth. I've said this before. I think it's going to go a lot higher. But I like copper, and again, I prefer. I like to say this. I'd rather be long copper than NASDAQ. I think there's a lot more things going for copper than the NASDAQ itself. The entire base metals industry is about $1 trillion in market cap in aggregate. They're producing somewhere close to $18-20 billion of free cash flow. And so there's, this is using numbers from December. We had a run up in base metals. I really want to see where we're going to be in terms of growth of free cash flow in that environment. I'm seeing a lot more growth in the gold and silver space. But again, I think that this entire commodity space looks attractive regardless. I'd much rather buy that those companies that are actually producing for cash flow than other software companies that only have top line growth with no earnings, no free cash flow, and massive multiples that are not justified by the current macro environment.
Got it. Okay. Now, I'm getting a couple questions via Twitter here for you, Tavi. The first one is, what's your commodities exit strategy? What leading indicators would you look for to know we're nearing a top and it's time to start de-risking?
Well, I think those ratios I referred to, such as the commodities to equity ratio, gold, silver, copper relative to money supply, when you start seeing those peaking, I think that's the time to be getting out of that. And honestly, I think there are some folks like to be invested in tangible assets during their entire investing career. That's not so much my case. I think this is much more of a macro setup that we have that may last 5 to 10 years, depending on the commodity. And so I much rather build a business around this opportunity and really try to implement this as best as possible. As of now, in terms of the way we're implementing and the prices that we're being able to buy in terms of securities in general in the space, we're nowhere close to the peak of this, especially in the precious metal space where things are just incredibly cheap still. The copper space too, we've had a few stories, luckily or not, that turn out to be more copper stories than precious metals than we thought. And with copper prices where they are, I guess that's not a bad thing. And so our exposure to copper actually increased given the price of copper rising, and also the development of some of those discoveries that we've had. I'm going to try. Answering your question really is once we've got with this development of inflation, done, then I think it's time to move on back to equities and look for what's the new sectors of the economy that we should be focused on. I don't think that's the case at all today, and not what I'm focused on. We haven't even started the M&A phase in this space. Just like I had a discussion a few months or maybe a year ago with some major companies in the gold space, and I'm talking about real majors, and there were no interests back then in terms of buying copper projects, and now seems like there is some more. It's interesting that we asked the same question recently regarding some of the new discoveries that we've had in our portfolio and offering them the idea of co-investing in some of those. And their answer was pretty simple, was that we cannot do that right now. We have to explain every cent in our income statement and cash flow statements. And we would never be able to really justify an acquisition at this moment of a project that is not profitable, of a project is just perhaps a good hope of a good discovery. And so, we know that changes over time. If they want to, if we're right, and they're going to be probably paying up for those projects down the line, I think that's what's going to happen. Those usually, unfortunately, a lot of those management teams tend to make those decisions the wrong way. They're not macro investors, and so I think that's what's going to happen. We haven't even seen the beginning of that yet. And so I'm very bullish in the whole space, and it's really, we don't know when gold, silver, even copper, will continue to probably move a lot higher, but we don't know when the even bigger move may happen. And so it's important to be positioned and continue to look for really good risk reward opportunities in the space.
Okay, I love it. Just given the time, I'm not surprised that this question is asked a few times. What are your views on Bitcoin, Tavi?
Well, that's a good question. I've always sympathized with the thesis, and I always liked the community in general that is more the awareness of the monetary debasement issue that we're seeing for so many years, but certainly has been magnified in the last year or so. And again, just like copper, deserves to be at higher levels relative to NASDAQ. I also, and I'm comparing the two because of the cyclicality. I also think that Bitcoin deserved to be better, to be at higher prices relative to a lot of the tech names. As of today, I think we've seen so far, especially this year, a lot of frothiness in the space. I think the crypto market looks a lot like the internet market, where a lot of, we don't know yet who are going to be the winners and losers. And I think in a few, there's no rush to be in the space, in my opinion. There seems to be all this rush from a lot of people. And I think it's a bit ridiculous. And that's just my opinion. I think the rush for me is on something that is more, less on favor, I would say, especially monetary metals and things like that could become, a bubble at some point. I'm much more interested in doing that, where not a lot of folks are interested and still very skeptical. The Bitcoin trade seems a kind of like a consensus trade in 2021, just like back in August in 2020. I think gold was a consensus trade as well. And so it needed a pullback, a recharging period in order to correct and then perhaps move a lot higher. And I think that's what we're seeing. We're still in the secular bull market for that. I think there's going to be a lot of the interesting developments. Obviously, there's a lot of smart folks getting into the crypto space from smart places, and I know some of them. And I don't think they obviously will build something that will be very useful, just like the internet was for us in the early 20s all the way to now. And so, I just think there's no rush to be involved in the space, especially given where we are. I find it interesting that we saw MicroStrategy really peaking way before Bitcoin. It's just a levered play on Bitcoin, what seems like down now, 60% since February. Yeah, it went down 99%. Back in the tech bubble. So I guess there's more to go. But when you look at the entire space, Coinbase, down 40+% since the IPO. You have ARK Investments down significantly as well. You got software stocks already peaked back in February too. And a lot of the hype names like Peloton would be a great example of another one, or Shopify, things like that. I think they're all part of this sort of frothiness environment. But do I like the developments happening in the crypto and the people that are more aware of the monetary debasement problem? Yes, I think that's great. The issue is we have all the macro factors to die for gold and silver. And people, especially the prospects and people that want to invest at Crescat and talk about gold and silver. And the biggest question I have is not about how that's going to shape up. The biggest question I get asked is if Bitcoin is going to replace gold and silver, and I think that's absurd. That goes to show how the sentiment really is still, for the metals. Bitcoin is not a metal. It's never going to replace gold and silver. It may replace somewhat in terms of capital flows here and there, and may become more part of some folks' portfolios and pension funds and so forth. But gold is ultimately what money is, and it's still going to be that case. It's a tangible asset, and it's very, it's only not as useful as a metal itself because of the price. Otherwise, it would be. And so, there's certainly a need for metals like that. And so I don't, and I think I find it a bit weird to see that type of sentiment when we have, if you're coming back from Mars and I tell you all it's going on today with political environment on top of it, I think it would be all over gold and silver rather than asking the question of if they're going to be replaced by a technology or another asset that, may actually offer different propositions in terms of developments in general. So I think that's my view on that.
Yeah, I'm with you on that one. It's such a funny comparison to make, isn't it? And I get it. But to compare an asset with a 12, 13-year history to an asset with a 5,000-year history, is like premature at best, but more likely it's just ludicrous. And I have a place for both in my portfolio. Like I'm a Bitcoin investor and a crypto investor, fairly passive and a dollar cost average in all this. But yeah, I've never been able to draw that comparison and like wrap my mind around that argument, other than just like, to your point, frothy sentiment. This is the new hot thing. It's replacing gold because, we love it now. But yeah, I'm with you, man. Okay. Look, Tavi, it's been great having you back on. Thanks so much for making the time to come back in front of my audience. I really do appreciate it.
Jay, it's my pleasure. I'm always happy to be here. So thank you very much for the opportunity.